YouTube is live, and away we go. 4 people in the room today. Love it. Oh, there's 6. Now we're rocking. Good to have you guys in here. Hope everybody's doing well. Can you hear me okay? Volume check. You guys all right? Nobody? Yes, we can. Okay, cool. I was like, I'm going to panic real quick. Hope you guys are good. Hope your weekend was amazing. Hope life is treating you right. You'll be here till you're not. Me too, Gary. I had that exact same plan today. I like it. Seems like a good way to do it. Checking news, guys. There's not a whole lot going on in the wonderful world of news. There was the Empire State Manufacturing at 8:30. Didn't do much to move the market. But every morning I stop by here and I check forexfactory.com. Hey, Steve. And I just make sure there's not any high impact news coming around because that's the stuff. When you see those big spikes in the market or those big jumps in the market, a lot of times they are a result of that high impact news. So this just gives you a little edge, lets you know when things may go a little crazy, when you may want to sit on your hands, sit it out, watch the market instead of try to trade it. That's a choice that ultimately you will make based on your experience. Everything that I talk about today, guys, is from the Nexgen page. There really aren't any secrets when we talk about the software. But before we get into all of that, just a little heads up. I did roll S&P, I did roll NASDAQ. Looking at the daily volume, they're just about split. We'll see what happens after the open. Um, but it's just time to make that roll. So if you're looking at your charts and they don't agree with my charts, guys, there's a good chance that we're not on the same contract. That happens every time we roll. Just wanted to make sure that you guys knew where I was. And then from the Nexgen page, guys, if you go to the trading guides, the trading plan rules, this is really everything that I talk about. We focus really heavily every morning. We talk about one trade, which is what we call a high probability trade, guys. This is the way the classroom is designed. It's designed to ease you into reading the software so that you can grow with the software. And we use this high probability trend trade as our base trade, as our first trade, because this is a trade that when you learn the rules and you learn how to follow the rules, it's a trade that has the potential to win up to 70 to 80% of the time. It's a trade that creates a lot of confidence through that memory of success. But most importantly, it's a trade that's going to teach you to read your indicators. The indicators are tools. I want you to think of them that way. You have a toolbox, and inside of that toolbox is a hammer and a screwdriver and a saw, and you've got to learn how to use these things effectively to become a carpenter. Your next gen indicators are very much the same thing. So we're going to have trigger lines and areas and all that good stuff, and your job is to learn how to read them. My job is to teach you how to read them. So we're going to work together. This is kind of a little symbiotic relationship that we have going on here. And the easiest way to learn to read your indicators, and when I say learn to read your indicators, I want you to be able to look at your chart and say, hey, I have the advantages I need to feel comfortable entering a trade. Or maybe even more importantly, I don't have the advantages that I need to feel comfortable entering a trade. And what you'll find is that your chart reading, waiting for those advantages, is usually about 90% of your day, most days. Um, Actively trading, getting in and out of the market, managing trades, making money, all that good stuff, that's about 10% of the day. And you're embracing the 90%, understanding that it's better to have an advantage than to be busy. And that 10% is when the advantage or that edge is present. Once you learn how to read your indicators, once you start looking at your charts and saying to yourself, wow, I have momentum, or boy, this is a clear path, which are the two things that we really focus on this morning, you're going to begin to understand things like where the market is likely to continue. And this likely to continue is actually the entry for the high probability trend trade, for medium probability trend trades. It's just being able to pinpoint a spot where the market is most likely to bounce and just continue with the trend that has already been identified and established. You will understand where the market is likely to go. Likely to go works its way into management. If I'm in a trade and there's a Fibonacci area in the distance and I have all the momentum pushing me, I could say, wow, the market's likely to go there. That's where I'll put my profit stop or my profit target. And then finally, you'll understand where the market is likely to stop. And these are what we call termination conditions. And a termination condition is nothing more than a line on a chart that you'll be able to see before the market ever reaches. And you'll be able to say to yourself, okay, this is an area for a potential top or bottom. I choose not to trade into it. And these three concepts all come from only one trade. And the trade is the high probability trend trade, guys. Nexgen has been teaching this for as long as I can remember. And this is your foundation trade. This is your base trade. This is the trade that teaches you to see the other trades. It teaches you, excuse me, to recognize advantages. And then ultimately you learn how to capitalize on those advantages. So the high probability trend trade is a three rule trade. Simplicity. I let on a lot. I tell you guys, hey, I'm not a math guy. I'm not that smart. I'm right-brained. Guys, I do that because I want you to understand that you don't have to be a rocket surgeon to figure out the software. It doesn't matter who you are or where you came from or what you did in life. All we're going to do is we're going to recognize a pattern. And this pattern is put in place when the rules are met. So the first rule, large chart must have strong trigger lines, provides the advantage of momentum. It lets you know that this is a market that has so much pressure behind it, it's going to be difficult to stop its progress. Rule number 2, terminations false, room to profit targets true. We want to have room to make money, and when there's none of those termination conditions, those likely to stop the market areas, we're going to call it a clear path. So when you have momentum, you have a fully loaded semi going down the highway. When you have a clear path, there is nothing in your way for the next 100 miles, guys. And it's going to be difficult to slow that thing down. So momentum and clear path are actually the core, like the foundation, the first two advantages that I want you to work towards understanding. Because once you have momentum and clear path, once you can identify these two concepts, you really do have everything you need to create a trading plan outside of the very basic, outside of the what feels restricting. I don't want to take one trade. I want to take 3 or 4 trades. Well, once you understand momentum and path, you begin to see those other trades. Rule number 3 is pinpointing that likely to continue spot, that area where an established trend, actually that has momentum and nothing in the way, you're going to be able to pinpoint the best spot for entry, the highest probability spot for entry, the lowest risk spot for entry, and you're going to do that with rule number 3. Your entry area rule is specific to the trend trade. This will change as you grow with the software. You'll find a lot of spots where you may be able to enter the market. All of these rules, these 3 rules, happen on only 2 charts. There is a big chart, a large chart. It's a very slow moving chart. It's a broad stroke of a brush, guys. And it shows you the overall opinion of the market, if you will. So if my large chart says, hey, we're in a downtrend, your highest chance of success comes from following the trend on the large chart. Your large chart, within the very first bar, the most currently printing bar on that chart, will define direction, momentum, and areas. So it'll tell you which way you have to be going for the rules to be met. It'll let you know if those first 2 advantages are in play, all in one bar. When the rules are met on the large chart, when both rules 1 and 2 are true, you have the advantage of momentum, your path is clear, you'll turn your attention to a small chart. And this is a very fast chart. It's a refinement chart. Inside of this one bar are all of these bars. So we use that refinement process to really pinpoint the best of the best entry, the highest probability entry, the lowest risk entry, and the one that gives us the most room to get to our profit targets. So this refinement chart is where entries come from. This large chart is where those core advantages that have us looking for entries comes from. We use these 2 charts because they lend themselves to the metaphor. Who are you trading with or against, guys? Your large chart, your big chart defines direction and areas and momentum, and this is the crowd that typically wins. We embrace everything they're doing. Those are our first 2, our core advantages. Your small crowd is like these fighters, and they create what's called a pullback or a retracement. And I believe the clinical definition of a retracement is a small movement counter to the underlying trend. We're going to take advantage of this small chart fight of these guys pushing down. And rule number 3 is going to have you pinpointing right where their failure is most imminent. And this becomes your entry for the highest probability trend trade. That is the area where the market is most likely to bounce and continue with everything that the large crowd wants. So we love the small crowd, and we embrace their fight because we capitalize on it. It allows us to reduce risk and maximize profit potential. Good morning, Cav. Good to see you in here. So we really dedicate about 45 minutes each morning to looking at the rules for the high probability trend trade. We're going to break them down individually. So we're not going to say, how do I find the trade? We're going to say, how do I recognize the advantages that create a trade? So we're going to learn the trigger line of Fibonacci rules for when it's okay to trade. And the easiest way is to say it's okay to trade when my rules are met. Guys, your rules are going to describe a pattern. And this pattern is going to be repeatable, it's going to be testable, and you'll be able to prove that that pattern wins more than it loses. And that's your goal, is to trade that pattern. Simulate and practice. Let me read what Cav said real quick. Only remote today on the naval base doing the construction project. Right on. We'll see you Thursday or Friday, man. I've been in the shipyards down in San Diego before. Those are pretty cool. It's not a naval base, but they build Navy ships. So have fun with that, man. Newport, Rhode Island. Sounds cold. Even in June. Sounds cold. One of the things that you guys are able to do is to simulate, is to take trades, to enter, to exit, to win, to lose, and you can do it in this simulated environment where you can't lose real money, where you can't blow out accounts, where you can't get the people you love mad at you for the losses that you take. And I think so often people avoid this first step to becoming a confident trader ASAP. And it's because of pride, of ego, of whatever, fear of being wrong. But I encourage you guys, as you practice and you learn these things, take a picture and drop it in the room. Open the door for a private session. And that's exactly what it is. Every time you post in my room, I'm going to click on your chart. And Paul, you've got, oh, and I'm going to say, all right, let's see what you did, and let's see where you did it, and let's look at what your chart read was and make sure that you were reading charts accurately. And let's look at your entry and see if it was the lowest risk entry. And let's look at your exit and see if you jumped out too soon or maybe held too long. And what happens is, from the one picture that you put in the room, sometimes you accidentally go long instead of short. We've all done that. There's a good lesson there. Pay attention. But I've done that probably 30 or 40 times, Paul. But every time you post in the room, guys, we're going to cover those advantages. We're going to cover what you see. We're going to talk about your chart read. And I'm going to help you out. So if you post in the room and you say, hey, Mark, this is what I saw. This is what I thought of momentum. And this is what I thought of that path. And here's where I entered. And here's where I exited. What you're doing is you're saying, Mark, am I doing it right? And I'm going to let you know if you're doing it right or wrong. We're going to celebrate victories, and we're going to correct any mistakes that you make. But even more importantly, when you begin to go through this process of annotating your trades, guys, your annotations are going to serve as a recipe for repeating trades that win more than they lose. You're literally describing the pattern that's creating these profits. And they will change as you identify challenges you may not, also identify challenges that you may not have seen initially. So if you post in my room and you say, hey, Mark, I had the best momentum ever here. Look at these strong triggers. And they weren't, we'll say, okay, well, let's go back. Let's back up and let's take a lesson on strong triggers, or let's take a lesson on termination conditions, or let's focus on how the advantage wasn't quite present, and here's how you avoid it in the future. So post in the room, guys. The people that post the most get to where they want to be the fastest. That has been pretty much gospel truth for as long as I can remember. The second thing is using the spreadsheet that I'm about to give you. I give it in the room every day, guys. And this is the trade tracking sheet. But what this does is it gets you focused on the looks that you're going to commit to. And I can't stress enough. This trade is a pattern, right? And you've got to learn that pattern so that it becomes easy. So the spreadsheet that I just dropped in the room, it works off the idea that repetition creates recognition. So the first tab is what it looks like to have your rules met in the green, because I want to trade when I have an advantage. I want to trade when I have an edge. I want to trade that pattern that has been proven to win more than it loses. And my goal is to sit still when I don't have an edge, to do nothing when I don't have that advantage. So you've got strong triggers, rule number one being met, but you've also got pictures of weak triggers, what it means to be patient, to wait, to be in that 90%. The same is true with a clear path and those termination conditions, a little bit on the entries. And the idea is that a brand new user, you don't put the pressure on yourself to find the trade. Put the pressure on yourself to learn the advantages, because the advantages come together to produce the trade. The second tab is the advantages coming together. And if you start clicking on these pictures in green, these are Nexgen clients that have posted in my room that have said, hey, Mark, I took a high probability trend trade. Could I get a little feedback on it? And I look at it, and the feedback is, holy smokes, you did it perfect. You followed every rule. What a great trade, whether it won or lost. The pattern recognition is outstanding. Let me steal it and put it in the spreadsheet, because the people coming behind you can use that to study. You guys are the people coming behind them. It breaks down the entry sequences on that smaller, faster chart, showing you exactly what you look for, exactly where you look for it, all the way down to exactly where your limit order is going to go to wait for the market to come hit it. There's ideas on management, and you're going to begin to see things as you recognize advantages. At first, you're hyper-focused on strong triggers, clear path, entry area. Let me catch that high probability trend trade. I would say within a week, you're going to begin to see things outside of it. You're going to recognize it. You're going to be focused on your rules, but you're like, man, I keep seeing this thing off in the distance. And every time this happens, that seems to be the result. Guys, take pictures of it. Drop those pictures in the room. And then build your own plan. I'm going to hand you a plan. It's a plan that is based on simplicity. It's a plan that is based on giving you a way to optimize your chances of success with the software as you learn to read it. I want you to understand that the plan that I hand you is not shackled to your ankle, trying to drag you down. The plan that I give you is going to be focused on getting you to read your indicators. You will see things. So start to build your own plan as you begin to find more, do more, see more. Guys, when it fits your rules for the trades you want to take a lot of pictures of it. Commit it to memory. Drop it in the green section. You're going to learn to manage outside of the very basic management that I give you. As you see things that make management easier, faster, more reliable, drop those pictures in here, annotate it, create that correlation between what you see and what it means, and then you even have a spot for your patterns. And then finally, there's the trade tracking sheet. I think it's important to stress that winning doesn't always equate to long-term success, and losing isn't always a failure, guys. You're in an education process. So I want you, every time you take a trade, to annotate that chart the way we did it. 3 rules, look at it, let's see what's going for me, and drop a picture of it in here. You can identify both momentum and path, those core advantages. If you want to add a section that says this is how much I made, if that's what you want to do. And then finally, there's a section that's feedback from class. This is the one that paid the biggest dividends for me, because what I started doing, and I'm going to encourage you guys to do, is every morning just go back and look at what you did the previous day. So this morning, I took 3 or 4 minutes and I looked at the trades that I took on Friday, and I said, what worked? What didn't work? Because what I want to do is I want to repeat the things that are bringing me success, and I want to avoid the things that seem to be taking that success. You'll notice that when you're following rules, when momentum and path are in play, trades begin to feel easy. And as a new user, it's hard to imagine that this would feel easy, but it really does. When you get into a trade and you say to yourself, holy smokes, I have momentum, and my path is clear and I define the perfect entry, you have this calmness about you because when you do the study, you know that it wins more than it loses, and you actually become okay accepting losers every now and then. It's just a cost of doing business. And you'll notice that when you break those rules, when you knowingly, willingly break your rules and forfeit advantages, you begin to feel a little nervous. Maybe your stops move a little quicker than they should. Maybe your targets get shuffled around 73 times in the middle of a trade. We've all done it. But if you do this brief historical study each morning, guys, it prepares you for the day and it keeps you focused on the great things, but it also keeps you focused on avoiding the stuff that may be creating problems. So, our morning, our first hour, is laid out like this. We're going to learn the rules, we're going to learn them individually. I'm going to give you a couple things to help you study them. The spreadsheet is one of those things that's already been dropped in the room. And we're going to talk about how to piece three advantages together to create the highest probability trend trade that Nexgen teaches. Your job is going to be post in the room and take advantage of having a coach, guys. Take advantage of having somebody whose sole purpose in life is to give you feedback on everything that you do. I had a wonderful conversation this weekend with somebody, and they were just telling me, man, I don't think I can get this. I don't think I can do it. And he's been with me. She's been with me. I don't remember if it was a man or a woman, but they have been with me for about 5 weeks now, and hasn't posted one trade for feedback and refuses to take pictures and won't ask questions in the room. And they're wondering why they seem to not be moving forward as quickly as they'd like to. And I had to tough love and say, hey, there is a path, and it means participation and it means study, guys. This software is amazing. I firmly believe it's the best software out there. You will get out of the software what you put into it. The time you put into learning it is going to produce results. I've seen it for a long time now. So post in the room, keep it simple, and understand that this is where we're at. If you're a brand new user, we're learning to crawl. We're learning to recognize advantages. This is the one that opens your eyes to the rest of the trades. This is the first trade on the plan that I'm going to give you. It takes you to the second trade on the plan that I give you, and it's a plan where it begins with a high probability trade, a trade where each indicator on every chart agrees with the rules for the trade, and it carries you to what we call a medium probability trend trade, which is a trade where most of the rules agree with the trade on all the charts, but an issue exists. And we're going to rely on your ability to read indicators, what you develop in this high probability trend trade to make this trade effortless. And then once these two become second nature, there's so many more opportunities. Nexgen teaches more trades, and then some of you even create your own trades. And I love it when you guys do that because they tend to be the result of momentum and path. So keep it simple. Understand that we're going great places, but we're going to build a solid foundation to get there. And over the next 20 or 30 minutes, we're going to talk about these three rules on two charts individually. And everything starts with the large chart, guys. That big, slow chart leads the way, and it must have strong triggers because strong triggers provide the advantage of momentum. Strong triggers is nothing more than space between a couple lines. So on both charts, you're going to see trigger lines. You're going to see small triggers. These are two solid lines. They're a fast-moving average. You don't even have to know that. And you're going to see large triggers. Large triggers are two dashed lines, and they're a slow-moving average. The background color will let you know which direction you're looking for the strong triggers. If it's green, the market's going up. We're looking for strong triggers up. If it's red, the market's going down. We're looking for strong triggers down. And it's a convenient little cheat code there because when my background is green, the only way to have strong triggers is if they're both green as well. And if the background is red, both sets of triggers must also be red. Now, what does it mean to have strong triggers? Well, it means that in an uptrend, your small triggers are up and above the large triggers, that your large triggers are widening and the smalls are above, and it's this space created between the small and large triggers that lets me know that the odds are favorable for the market to continue up. And it doesn't matter if it's a little space or a lot of space. When there is space between the small and large, the odds are favorable for the market to continue up. In a downtrend, when the smalls are below the large, when there is space between the small and large, from the big gap all the way to the little gap, the odds are favorable for the market to continue down. So one of the things you're going to hear in this classroom is odds favorable momentum, OFM. You'll see it annotated on charts, because when I have odds favorable momentum, I have a market that is likely to push in the direction of the trend. It's a market that has the strength in it to potentially break key areas. These strong triggers are going to even cover some of the mistakes that we make as a new user and create some exceptions for the experienced user. So strong triggers is really nothing more than separation. And then when the separation goes away, when the small triggers work their way back inside of the large triggers, we call this weak triggers. And when you have weak triggers, anything can happen up or down. Since it's Monday, I'm going to talk a little longer, but I want you to listen to the language that goes with the look, guys. If I look at this, separation between the small and large, my brain says odds favorable for the market to continue down. I can feel the advantage in the words that I use. When I have weak triggers, weak on its own is a pretty good description, but I'm thinking to myself, anything can happen up or down, which means that I no longer have an edge, and successful traders demand an edge. So strong trigger lines, that's rule number one. It is a look that doesn't happen all day long, but if you see the separation, you have strength. If you see the smalls back inside, you have weakness. If the colors don't match, guess what? You're in a transition period. The buyers and the sellers are fighting one another, and the advantage of momentum isn't present. This is where it's better to sit on your hands and do nothing than it is to try to predict where the market's going to go. Weak triggers, big retracement, weak triggers, big retracement. And then even with strength, that market stopped cold and went the other direction. And guys, that's because it reached an area. It reached what we call a termination condition. How's that for a segue to rule number two? But before I get there, is everybody okay with that? Rule number one, guys, large chart needs strong triggers. It's a separation. That strength is a huge advantage. And you're going to see people in this room that take trades really based only on momentum sometimes, and they still do well. Once I have it, I want to make sure that there's nothing in the way. I want to make sure there's no termination conditions, none of those likely to stop the market areas. I want room to my profit targets, guys. I need a clear path. A termination condition, when you look at the instructions, it's defined as a Fibonacci-based indicator that may reverse the market based on a comparison of the area and the trigger lines. So the trigger lines stay in play. I like to call them horizontal lines on a large chart, guys. And they all have names. So areas that may stop the market when the market reaches them. So there's divergence highs. This is the magenta line, and that magenta line prints off of and extends right from a pivot, and a pivot means the market went up and down or down and up. And what it signifies is that there was a loss of momentum in the move. Your software works behind the scenes running calculations, and if the market was pushing up and then went back down and momentum didn't follow this price, you'll see that magenta line. If the market was going down and then it pushed up and momentum wasn't following this move down, you'll see a cyan line, a baby blue line. So anytime you see one of these divergence lines, I just want you to say, wow, there was a loss of momentum. Divergence is a loss of momentum. Fibonacci resistance, the red line runs horizontal. This is an area when the market is trending up. Resistance could stop it, could create a bounce, could set off a fight between those buyers and sellers in the large chart from the large crowd. And then support, equal and opposite reaction. If the market is trending down, this area of support is a visual, hey, this could stop the market. This could create a bounce. This may reverse it completely. And yellow one-to-ones are also on this list. And these yellow one-to-ones, when the market is trending down, may behave as support. And when the market is trending up, they may behave as resistance. So these areas on a large chart, horizontal lines on a large chart, guys, these are the areas where the large crowd is most likely to make decisions. These are the areas where the buyers and sellers are likely to fight, where trends can end, where new trends can begin. So when you look at your big slow chart, I want you to just say, okay, decisions might be made. They may be made. Ooh, boy, that picture was too big in there. Let me see if I can fix that. Um, Son of a gun. I was doing some modification this morning. Um, my apologies. How's that for just missing my groove for a second? There we go. So what happens is these are the areas where decisions are made, where the large crowd gets in, gets out, where they can fight. And let's see if saving that made it come up right. There we go. So we're going to let the large crowd get to the area. We're going to let price reach an area. So when price reaches an area, whether it is Fibonacci resistance, one-to-ones, divergence highs, or price reaches an area going down, whether it is support, one-to-ones, or divergence lows, price reaching the area is what sets off that decision-making process by the large crowd. So price reaches Fibonacci resistance. All I want you to do is ask yourself, where are my triggers, guys? And if my triggers, small and large, remain below resistance, and they will, every time it hits resistance, it'll be a termination for a minute. You can say to yourself, price reaches the area, I'm done with price, let me look to the triggers. My triggers remain below resistance. Resistance is a termination condition, guys, and because it's a termination condition, there's a couple things that can happen. The market could get set off in a fight between buyers and sellers that I don't want to be a part of. The market could reverse completely off that area, head the other direction. The market could just break the area. And I never know what the reaction's going to be. So if price reaches an area and the triggers remain below resistance, rule number 2 says be patient. No trades into the area. Wait for the reaction. Good morning, Wayne. And then price comes down and it reaches Fibonacci support. And once price reaches the area, we're done with price. We're going to look to the trigger lines to tell us what's going on. And the trigger lines, if they remain above support, are telling us that support is a termination condition. Absolutely no trades into that area. Wait for the reaction. Is it going to bounce? Is it going to break? Is it going to fight? I don't know. I'll just wait for the reaction. Good morning, Bob. You're working on TradingView today? Cool. Put all your pictures in the room. And then, Bob, what I have on my notepad today is when we're done with the Nexgen stuff, I'm going to stop the YouTube video and I'm going to create a new one. And we're going to talk about the indicators. We're going to talk about the plan and some of the mechanics. And I'm going to try to put together a little video in a live scenario. So that's coming probably at 11 a.m. Eastern, depending on where we're at. And if I need to run over today, you guys know I'm more than willing to run over. So I want to ask everybody in the room, are you good with that? If price reaches an area and the triggers remain below resistance or above support, it's okay to do nothing. It's all right to sit on your hands. Because what you're going to find, and let's just take a picture real quick, is that they couldn't get through resistance and it creates a big bounce. And they couldn't get through support and it creates a big bounce. And weak triggers creates a retracement right to support. Triggers didn't break. There's your big bounce. Divergence high. There's your bounce. Yellow one-to-ones. There's your bounce. So guys, rule number 2 is pretty freaking amazing. And what it does is it helps you to become patient. And there's price reaching Fibonacci resistance on the most current bar. And because the triggers haven't broken, all of you guys that are following rules are saying, you know what? Let me wait for the reaction. Let's wait and see what they do instead of hoping they do something. So that's defining a termination condition. Where the heck did my PowerPoint go? There it is. Once you recognize termination conditions, guys, you're going to be a little more patient. You're going to say to yourself, I don't have to trade into it. I can wait. Well, areas break. They break all the time because if they didn't, we would be caught in that range forever. So this might be too busy. Let me know if this is too busy. But when both of your small and large triggers pass beyond areas, so in this case, both small and large get below support, support becomes resistance. This is what it looks like when an area breaks. This is what it looks like when your path becomes clear, and your path remains clear until price reaches the next area, and then it becomes a termination again, and you pause and you wait for the reaction. And if the small and large get below that fib, guess what? We have a clear path again. So every line is going to be a termination for a moment, and then it's going to be a clear path. Can I go over what a good top and bottom is? Absolutely. Does it have to be from a native fib on the 13.2? Of course not, Jerry. You made that rule up. We'll go through it. We'll talk about it before we get off of termination conditions. Promise. So guys, the market is coming up and it reaches yellow 1-to-1s and the triggers remain below. And everybody in this room says, whoa, that's a termination. I don't know what the reaction is going to be. Let me pump the brakes and pause. And then when the small and large get above, you can say, okay, my path is now clear, and that path remains clear. Uh-oh. I think last time you guys had this discussion, Jerry, you lost, if I'm not mistaken. So if there's a steak dinner online or something, I want a cut. I want you guys to send me a bite of the steak. Guys, once small and large get above an area, that area is broken. Your path is clear, and that path remains clear until you reach the next area. So as a brand new user, Jerry, even better, I'll come to Phoenix and collect, and you can take me flying. As a brand new user, every time price reaches an area and the triggers remain above support, below resistance, I just want you to say to yourself, say it out loud. I don't know what the reaction's going to be. I'm gonna wait. I'm gonna wait and see what the reaction's gonna be. And one of the things that I try to never do in this room is speak in terms of absolutes regarding the market. It may bounce, it may fight, it may break, and I'll never know what the reaction is going to be. So when price reaches Fibonacci support, small and large remain above, guys, I'm going to sit on my hands and do nothing. It costs nothing to wait for an area to break or for the market to reverse. The rules met, high probability trend trade look, means that both small and large triggers get below that area of support, not price, triggers. Because when small and large get below support, support becomes resistance, guys. And my path remains clear until I reach the next area. And then once I reach these yellow 1-to-1s, I go right back to number one. So brand new users, let it be very black and white. It's either a termination or it's a clear path. And in a week or two of working on this and committing that to memory, it opens the door for number two here. Number two is what it looks like when an area is breaking. And it shows the potential of that area to break, and it uses the trigger lines, and it uses them two ways. First, it has to have strong triggers. For you to say, I have the potential for this area to break, I want you to believe that momentum is the gift that gives you the potential to break areas. Your trigger lines are going to tell you that potential is there, and we call this a 50-50 trade, and this is the second trade on your trading plan. And 50-50 is 50% of my trigger lines have broken through the area, 50% are not. Pretty clever, right? You could call it a straddle the line trade. You could call it a one below, one above trade. You can call it whatever you want. I call it a 50-50. And what a 50-50 means, when I have odds favorable momentum, when my trigger lines are working through but haven't made it yet, that potential gives me opportunity for the second trade. That potential gives me opportunity to take these entries, but because the path isn't clear yet, I'm just going to manage it a little differently. I'm going to have a little different rules in there that keep me focused on momentum. And this will be the second trade that you guys are looking to take. And I'm going to tell you the easiest trades that you'll ever take will have both momentum and path. The highest probability trades you'll ever take will have both momentum and path. And you'll see it like this. A little bit of separation. Remember, it doesn't have to be huge. As long as there's a little separation, we're good. All the triggers are above resistance. This tail is the pullback on the smaller, faster chart. These tails show where potential entries may have been. And guys, the path remains clear all the way to Fibonacci resistance. And then the market reverses and it creates momentum. And I haven't reached Fibonacci support, and there's another one of those tails. And guys, this is the easiest trade you'll ever take. This is the high probability trade. And if you look at a large chart, what you'll notice is that these fibs are recognized and used by the people in control. Huge move, straight from Fibonacci resistance, and it died at Fibonacci support. Pulled right back to Fibonacci resistance. Support had the potential to break but didn't, and the market continues up right to that next area. So just a little scrolling, nice and slow, you begin to see how effective these areas are. You begin to see how accurate Fibonacci is, and you really begin to develop that trust that says, you know what? I don't have to trade into an area hoping it breaks. I can let it show the potential, and with that potential, maybe there was an opportunity to capitalize. And when we talk about entries, guys, we'll go back and look at that tail where the smalls are above and the large are below, and we'll see if that was actually a termination condition or a potential entry. So now we're going to talk about a concept for Jerry, and this concept is going to be a strong top or bottom. So up here, I'm going to write the definition for you, Jerry, and this definition remains constant. A strong top or bottom is first a termination condition. And a termination condition means price reaches an area, no triggers broke through the area. So what we have here is first a termination condition. So this is an absolute. And remember, if the small triggers break through the area, Jerry, that's no longer a termination. That's what we call a 50-50 look. So a strong top or bottom is absolutely no triggers through the area. Does that make sense? That's the first step. And Jerry, for you to lose this bet, the key word there is area. So when I say area, he wins again. I know. It's hard being the dad sometimes. But when I say area, guys, I mean any of these areas that we talked about in the beginning. I'm talking about divergence highs. I'm talking about Fibonacci support and resistance, yellow 1-to-1s. Any termination condition that reverses the market can be a strong top or bottom. So the second part is when the market reverses from a termination condition, meaning the large triggers pinch and roll and change color. So what this is, then it's a strong top or bottom. So first it's a termination condition, and then right here, now it's a strong top. And right here, now it's a strong bottom. But it takes both. It takes first a termination condition that no triggers break through, and then it takes a reversal from that. And guys, what this means to you and why it's labeled strong top or bottom, the decisions made at a key area were so impactful, I love that word, that the market stopped, reversed, and went the other way. Now, why do we talk about strong tops or bottoms? Because it was so impactful, any high probability trend trade that you take after a strong top or bottom is the highest probability trend trade that you can ever take. This strong top or bottom becomes rule number one for the second trade in your plan. This strong top or bottom is rule number one for momentum trades, for high volume area trades. So while it's not a rule for the high probability trend trade, being able to recognize a strong top or bottom sets you up for the best of the best. So he won again, Jerry. One of the things that people do, and I'm gonna share this picture with you guys real quick. So your large chart has all of these areas on it, and one of the things about the Fibonacci areas on a large chart, I love it, is we pull them. There's 3 different time frames. And you'll see them in the way they print on the chart. A very skinny fib that doesn't extend off into the gray. This is from a 5-1 chart. That's your entry chart. The big fat chart, or a big fat fib that doesn't extend all the way to the right, this is from a 21-3 chart. This is actually a higher time frame, increasing accuracy. And then if it extends through the right, that's native to the 13-2 from your large chart. And Nexgen uses all 3 of these because none of them are more important than the other. These key Fibonacci areas, whether it's a 5-1, a 21, or a 13-2, all have the ability to stop the market, and they all have the ability to create reversals and fights. And if you just look at this picture, you'll notice that the 21 stops the market here, that the yellow 1-to-1 stopped the market here, that the divergence low does it here. It was a 5-1 fib that created the bounce here, and it was a 13-2 fib that creates it here. And one of the things that I really encourage new users, don't rank them. Don't make one more powerful than the other. If it's on the large chart and it's a part of that Nexgen workspace, guys, these lines are important and they all have the potential to stop the market's forward progress. So great lesson there. And you know what? I love that Josh is getting a stake out of it. So what we've done is we've talked about the large chart, guys. We've let the large chart lead the way. We've talked about having the advantage of momentum through strong triggers, insisting that the path is clear by not having termination conditions. And once these 2 are in place, one of these days, Jerry, we're talking about, depending on how this last contract plays out and the timing, we may do the California run and down through the Southwest again. If we do, we'll make a stop in Phoenix just for dinner. It'll be fun. So momentum and path, guys. And once these are in play, we're going to look for entry. Hey, Lava Lamp. Been saving up money. Got a new PC and a laptop. I love it. However, your NinjaTrader and Nexgen files are on your old PC. How would I go about removing? So, Lava Lamp, we're going to make it even easier for you, man. I don't want you to put that burden on you because I have a guy, Jason. Let Jason do it for you. What they're going to have to do is they're going to build you a brand new set of indicators, a brand new indicator file, because the file that you have is specific to your computer. So what Jason's going to do for you is he's going to create 2 new files for your new computers. He'll disable the ones from the old computers, I believe, if you need him to. And then he'll put them on there and get you all squared away. If you try to just transfer the files over, what happens is the security kicks in and it doesn't let you do it. So put in a ticket with Jason. Let him hop on there. It'll take him 3 to 5 minutes. And it's a pretty easy process. Cool? Jason's amazing. I think a lot of times people don't want to bug him, but man, he's so good at what he does. I use Jason a lot. And then he'll have you full tilt boogie, and then I'll expect to see you in the room posting pictures, right? I hope so. Just show off a little bit if you need to. All right, so the large chart says we are screaming in the direction of the trend and there's nothing in the way. Rule number 3 is designed to get you into the market. This is just an entry rule, guys. And it says that you're going to use a limit order to buy or sell a pullback at an area inside of triggers. And it's a mouthful. But when you use rule number 3, what you're saying is that the large crowd says up, and the large crowd says momentum, and the large crowd says clear path. I'm going to let the small crowd fight, and that buy or sell a pullback, guys. You're going to buy that little push down created, and you're going to do it in an area. You're going to do it at a fib, at a mid-band, at a yellow 1-to-1, because the same way areas on a large chart can stop the trend completely, those areas on a small chart, guys, those can create that bounce in the direction of the trend and the direction of the momentum. So we're going to use a limit order to buy or sell a pullback right at an area inside of triggers. So this is what it kind of looks like, and we'll break it down even more. Large chart says down. And guys, let me know if you see this, especially if you're new. The background is red, the trend is down. So I go to rule number 1. Do I have strong triggers? There is separation between the small and the large. The space is there. Rule number 1 is met. So I go to rule number 2 and I say to myself, has price reached an area? It has not. Any areas up here to worry about? Not a one. Guys, I have momentum and I have path defined on my large chart. Is everybody good with that? The market will be trading at the bottom of this bar at a downtrend. On your smaller, faster chart, we're going to define the beginning of the reversal. That's this reversal bar, and this reversal bar says, hey, the fight is on. And we're going to be able to say the market is most likely to retrace, to push up to this point, somewhere from the bottom of the large to the top of the large and synthetic. These will define your retracement zone. And then you're going to find the areas within, the fibs, the mid bands, the yellow 1-to-1s, and you're going to say to yourself, this is where the market is most likely to bounce and continue with the trend. And all of this is based on the advantages from the large chart. So it takes one bar on the large chart, lets you know the rules are met, and inside of this one bar, you'll typically see a reversal, a pullback, and a bounce in the direction of the large chart trend if this is one of those successful trades. So let's break it down. In this instance, the large chart says up, the large chart has momentum, and the large chart has a clear path. The market will be flying north on your smaller, faster chart. And you're going to say to yourself, wait a minute, I don't just jump in with this methodology. You wait for the reversal bar. You wait for the small crowd to fight. You're going to be able to define where that fight is most likely to go, where the retracement is most likely to go, and you're going to use the large and synthetic triggers. Large triggers are native to the 5-1. Synthetic triggers are just the large triggers from the large chart, guys. Price returns to large triggers. So you define the retracement zone using them. But then you remind yourself, triggers aren't bouncy. I need an area. I need a fib, a midband, or a yellow 1-to-1, and it needs to be inside of the retracement zone, inside of those large and synthetic triggers. So from this midband, inside of triggers, to these yellow 1-to-1s, inside of triggers, this blue shaded box represents the point where the market is most likely to bounce and continue with the direction of the large chart. Because of large chart advantages, guys, remember your large chart has odds favorable momentum. Your large chart has a clear path. Your job is to activate a limit order a tick or two above the highest point of support inside of triggers. A tick or two above the area inside of triggers closest to your reversal bar, because I don't want to stumble over a couple pennies hoping to save a few dollars of risk. And when you do this and you learn this entry sequence, when the reversal bar prints, you're going to literally say to yourself, the retracement, those down bars are most likely to go somewhere ending at the bottom of these triggers. So the red box is where the retracement is most likely to occur. The bounce and continuation comes from areas inside. So it could be the mid-band, and it could be the yellow 1-to-1s, and I have no idea which one it's going to be. So I enter at the highest point, making sure I don't miss the move if they can't make it to the lowest point. And that's why it creates a window. But because you can define where the retracement's most likely to go, because you can define where it's most likely to bounce, you learn to ignore any areas beyond those triggers, beyond the retracement zone. And you're going to say to yourself, man, this isn't in the window. This is where the advantage of rule number 3 is no longer in play. This is where I no longer have an edge. I call anything in a long trade on the wrong side of the triggers where the market shouldn't go, below the retracement zone. So in a short trade, when everything is going down, you'll wait for the reversal bar and you'll say the reversal bar is not my entry, but I know where those up bars are most likely to go, somewhere from the bottom of the large to the top. And that's my retracement zone. But this defines retracement, not entry. Let me look for the areas inside of those triggers. Let me look for the area inside of that retracement zone. And it is one area. It's a mid-band. That's it. Your whole window is one line wide. Your job is to activate a limit order, a tick or two below it, and just say to yourself, all right, come get me. I've done all I can do, but I do know that all of these lines on the wrong side of the triggers, above those triggers for a short trade, that's not a part of my equation. That is not a part of the entry sequence. This is where the advantage is no longer in play. And guys, I'm going to tell you, once you get to the wrong side of the triggers, whether it's below the synthetics enlarged for a long or above the synthetics enlarged for a short, you have absolutely no idea if that market is going to continue, if it's going to bounce, if it's going to go in the direction of the trend. Your advantage is out the window. So by defining where the market is most likely to continue, you have defined where the market should not go if this is going to be one of your winners. And you're going to use that for your initial stop. All we've talked about is entries. This is the first mention of any sort of management. If I enter at the area inside of favorable large triggers, then my initial stop is placed where the market should not go, 4 to 5 ticks above those triggers. If I'm in a long trade and I enter the market a tick or two above support inside of triggers, well then my initial stop goes 4 to 5 ticks below those triggers, where the market should not go. And here is one of the realities of trading that I like to share with you guys, and this is an important lesson. When you follow the rules and you recognize the pattern, what you're doing is you're defining a pattern, a look that you can prove typically wins 70 to 80% of the time. And that's an outstanding feeling. But you've also defined a look that loses 20 to 30% of the time. What you've done is you've just minimized your risk by understanding the entry rules. And I'm going to tell you, and this is hard for a lot of people to swallow, 20 to 30% of the time, they're going to stop you out. 20 to 30% of the time, they're going to hit that stop. And you will lose money. And guys, it's a cost of doing business. It's paying rent for the privilege of trading the futures markets. It's okay. But your job, every time you take a loser, go back and look at it. Did I have momentum? Did I have a clear path? Did I define my entry? I did. Well, that's a trade that typically wins more than it loses. And if it's going to lose, I know exactly where I want to jump ship. And that's one of the cool things about this methodology is when you put it all together, not only are you managing your risk through strong triggers and you're managing your risk through a clear path, you're managing your risk by taking the perfect entry and knowing where the stop goes. So this is the pattern together. These are the 3 pieces of the puzzle to create a trade. Guys, this is your high probability trend trade. When the large chart has strong triggers, smalls above the large, space between the two, when you're not trading into this pink line and your triggers have gotten above the previous resistance, guys, this is what it looks like on the large chart to have your rules met. And the market will be trading all the way up here at 97.05. And you're going to say, oh my gosh, it's already gone. I'm never going to make money. This is horrible. And even if I did get into the market, this is 32 flavors of rotten because I only have 8 ticks to hit my profit target. And we've all said it. We've all done it. Let me show you why we use the refinement chart. Because where the market is trading here at 97.05, that's where the reversal bar happens. This is what sets off the beginning of the entry process. And once the reversal bar prints, you can say, well, that market is most likely to go somewhere from the top of these triggers to the bottom of these triggers. And that defines the retracement zone. But you've listened in class and you say, but that box can be so much smaller because the market is likely to bounce somewhere from the highest point of support to the lowest point of support. And if I take this entry, if I wait for the reversal, if I allow it to hit my entry and I let it run, that 8 ticks worth of profit potential turns into 30, guys. 80 turns into 300. Because you waited for the lowest point on that smallest chart, the areas inside of favorable large triggers, you have the least amount of risk in this trade. So this tail on a large chart, we don't trade this tail. You're going to predict where that tail is most likely to form using a small chart, using that methodology. And I believe we circled a tail, and that's what it looks like. You're going to use those circles to study. And I'm going to come back here, and this is a great example. There are 3 tails lined up right here on the S&P. All of them have momentum, and all of them have the potential to break that key Fibonacci area. Do you guys see it? There's your first one, there's your second one, there's your third tail. We can go to a smaller, faster chart, and we can say to ourselves, what do the tails look like in a live market? Well, the first tail was a pullback 2 ticks above the mid-band, may or may not have gotten it. And then it pulls right back to mid-band inside of support, and off it goes. And then it comes back and it pulls right back to support inside of a mid-band, and off it goes. And then it pulls back to an area inside of support, or an area of support right inside of those triggers, and off it goes. 3 different opportunities to capitalize on momentum and the potential to break. So you can go back and you can study these looks, and you can say to yourself, all right, there's momentum in a tail. It pulled back to the mid-band right at the bottom of the triggers. It never got where the market shouldn't go, and the market continues down. And if I back it up again, I'm starting to get the separation between the small and large. Oop, didn't hit an entry there, so I've got to back up again. And I draw a tail. And guys, all I'm doing is I'm looking for opportunities. I'm trying to commit this look to memory. That one was into a termination condition. That's your high probability trend trade, ladies and gentlemen. Large chart advantages, creating small chart opportunity to entry. That's what we're looking for. Coming back, crude oil. Right to the mid-band in the retracement zone. Do you guys see it? Pete said oil went nuts on big volume, and it did. Look at the timestamps. But the patterns, even in big volume. And Jerry, it was a strong top that reversed the market, that created the opportunity. And guys, that's your day. If you go from 70.11 to 69.67, that's over $400 worth of profit on the way down. That's your pattern. Volatility creates opportunity. So how do you get good at it? I promise you guys everything you need to be successful with the software. I'm about to give you the rest of it, guys. I'm not sure why. And I believe it's because we are all alphas. I believe because most of the people that come to me have been successful in a previous life. We're used to being in the role of teacher, not student. And I'm going to tell you guys, this is one of the most ignored parts of the education, but it's probably one of the most beneficial. The goal is that you're looking at a large chart, guys, that you allow it to be easy, that you're looking for momentum and path. This is the core. And once you understand momentum and path, guys, it opens doors for the rest of it. So I encourage you, can't make you, but I encourage you, go take 25 pictures each of strong triggers, of weak triggers, of a clear path, of a termination condition. But don't just take the picture. I want you to see this. I'm going to open up a large chart, guys. And with one picture, I'm going to draw an arrow. And I'm going to say, price reached resistance. Triggers below, term, no long trades, rule 2 not met. So what I did is I said, hey, here's my look. Here's the recipe to make sure I can identify it. The same recipe keeps me out of a loser here. The same recipe keeps me out of a loser here. The same recipe keeps me patient as I come into these next areas. That's one picture for termination conditions. I can also say, and I'll draw the arrows, this is what my eyes see. This is what my brain thinks. Separation between small and large. Colors match. Rule 1 met. Odds favorable. Momentum. This is the best of the best. So, guys, I don't have to take a trade to become a chart reader. I don't have to take a trade to recognize momentum. What I need to do is recognize momentum, recognize termination conditions, and that's what opens the door for me to take a trade. So go back and do this. Take the time to annotate. Get these into your spreadsheet, guys, and I've given you a huge head start. If you go through that process, and if you have new people in the room, go do it. And it'll take you 2 to 3 hours, maybe. Break it up over the course of a week. But when you finish this, you're going to be a better chart reader. So as you go through and do it, I'm also going to give you the cheat sheet to make sure you're taking the right pictures. This is the high probability trend trade checklist. And notice that it says, is the market coming from a strong top or bottom? That's what we discussed with Jerry. Guys, it's not a rule for the high probability trend trade. I can take a high probability trend trade without a strong top or bottom, but if I have one, it's happiness, it's warm fuzzies, it's great, it's the highest probability trend trade ever. Learn how to identify this, start writing on your chart where it came from, because you're going to use it for the next trades. Did I have momentum or was it weak? Only one, momentum, gets me to the next rule. Was it a termination condition or was it a clear path? Only one gets me to entry, and this breaks it down all the way to where your entry goes. The second page of this document is that same spreadsheet. This is printable. I've had people laminate it and just get a dry erase marker, and every time they look to take a trade, they're looking for these 4 things. And if the first one isn't there, it's still cool. You still could have a high probability trend trade. I've never had anybody, and since the inception of the high probability trend trade checklist, be able to truthfully mark yes to all 4 and do worse than 70% in their trading. Guys, this is the foundation trade. This is the basis. And these rules, the way it's written in here, this is what you can write on every chart. So if I take a trade, one of the things I can do, and if you have Snagit, and I encourage you getting Snagit, I really think, 83, that's right, Jerry. What you can do is you can take your checklist and you can say to yourself, you can literally put on there, did I have strong triggers? Well, I did. Did I have strong top or bottom? I did. Did I have strong triggers? Absolutely. Did I have a clear path? And I have to say no, it was only the potential to break. Did I have an area inside of triggers when we broke it down? Absolutely we did. Guys, this checklist is going to keep you focused on the best of the best. And Jerry's absolutely right. We had an engineer, and guys, engineers are amazing. You guys are thorough. They took this list and they ran it through and they tested it historically, and it was like 83% winners. And that's the reason that this high probability trend trade checklist is the first trade on the plan that I give you, because confidence comes from the memory of success. And if you can increase and optimize your chances of success, guys, you're going to be confident. If you're confident, you're going to stick to it, and you're going to adhere to the plan, and you're going to be excited about staying in the realm of rules because you're finding success. So this is the KISS plan, the Keep It Simple Sunshine plan, because I can't call you what Bob wants to call you, the final S. Guys, this is a stepping stone in your learning journey. This is the first trade, not the only trade. This is the trade that is, and this plan is designed to optimize your chances of success with that high probability trend trade as a new user. It'll be through simulation. through study, through class feedback, and continuous practice that you will be empowered to craft a plan tailored to your personal goals, and it will be based on your experience reading the indicators. My promise to you is that when you learn how to read your indicators in their most basic form, a couple advantages, you're gonna see more, guys. You're gonna see more opportunities. And when you feel like you've got it and it's time to test it, there's two things you need to know when you get off of simulator. The first one is why you will enter a trade. The simple answer is because my rules are met. Because my rules describe, it's a description of a pattern. That's it. And it's been proven to win more than it loses. And if you verify and trust that pattern, if you take the time to study it, to get feedback, to post in the room, to take those pictures, you will never miss that high probability trend trade entry because you know the potential that it offers. But you also know that there will be times, 2 to 3 out of every 10, it's just not going to work and you're going to lose money. And what happens is you learn through rules adherence the most valuable lesson that you could ever learn as a day trader is that you're not in control. You have no influence on what the market's going to do, which is why you rely on a pattern that can be proven to win more than it loses. And when you know it does both, it helps pull the emotions out of the trading. Then you have to know why you're going to exit. There's two reasons to exit a trade, guys. The first one is you hit your profit targets, and that's the best reason. The second reason is that something's gone wrong. One of the advantages that has gotten you into the trade is no longer present, and you may choose to exit. So by learning advantages, what you're doing is you're starting to open doors for management. We've defined the entry. We have talked excessively about how to get into the market at the absolute best spot. Once you're in, you've got to do something with your great entry, and great entries create very manageable trades. Great entries reduce risk, increase profit potential. So in the KISS plan, I've written the management plan that I used to squash my fears because I was terrified of losing money as a brand new user. Once I had something to lose, I was afraid to lose it. And I would exit positions at a tick. I would take the perfect entry and a tick into it, I'd go break even, they'd hit me and run, and I just spent a month being angry at myself. So I created a plan, and the plan uses two contracts. And it is designed to help you understand stop placement and to trust it, but it's also designed on getting you paid because let's be honest, that's the only reason we're here, guys. We want to make money. You will create a management plan based on your goals, and it'll be based on your ability reading the indicators, but until you read charts well enough, fast enough to do it, let's keep it mechanical the same way we did entries. So it is if then, the same way entries are if then. If my entry is 2 ticks below resistance inside of triggers, then my initial stop is 4 to 5 ticks beyond the triggers. And this is where the market should not go. And you will know your risk before you ever enter a trade. Guys, when the market is down here, you're going to start seeing your entry. When the market is still going down, you're going to know where your stop has to be. I want you to accept the risk, guys. Be okay with the risk. You're trading a pattern that typically wins 70 to 80% of the time. This trade was entered at 71.34. The initial stop at 49 gives $150 per contract. You have to be okay with that. Because if you put your stop in the retracement zone or anywhere near areas most likely to create a bounce, you run the risk of getting stopped out only to watch the market do everything your indicator said it was going to do and run without you. That creates frustration. Targets are predefined, $100 and $200, guys. We're learning to get paid. So if the market doesn't stop you out and take your money, and it will 20 to 30% of the time, it's a cost of doing business, normal part of a positive equity curve. If it doesn't do that, it means you got a reversal bar in the direction of your trade. And now you're going to redefine where the market should not go. Your new stop is 2 ticks above that reversal bar. And we can do that redefining because that reversal bar confirms that the market is going down from the area with momentum and a clear path. It's a confirmation that the trade is working, which is why we reduce risk. It doesn't guarantee that you don't have a loser on the horizon. But what it does is it says if something goes wrong, now you're only risking $30 per contract, and you're risking 60 total instead of 300, and that feels good, and it makes it easier to hold for the first target. If they don't come get you for that small loss, it means that they made it to the first target, guys. And if price reaches your first target, one contract is automatically removed. Those funds go into your account. That's success. That dries up sweaty palms. With one contract remaining, you're going to move your stop to break even. You're going to take all of the risk off of the trade, and you've been paid. And guys, the only reason to move your stop break even, not because that's where the market shouldn't go, because your second contract is designed to build trust in the idea that when your large chart is going down with odds favorable momentum and absolutely nothing in the way, that market is more likely to continue that path down than it is to head up. So if they don't hit your break even stop, it means that they go to the second target, and you'll be removed from the position. You're not in there anymore. There's no stress, no fear, no anxiety, no emotion. You're done, and you just made $300. And $300, guys, this is where one of the greatest lessons that nobody talks about. $300 a day. If you stop trading after that one trade every day, and that's the best you ever did, guys, that's a $75,000 year. Add $100 to the mix. That's a six-figure income. The futures markets trade billions every day. You need to capture 400 to be a six-figure income trader. And your account doesn't know where. Was it a home run? Was it a base hit? Did they make $700 on one trade? Or did they make $700 seven times on seven different trades? Guys, the goal is daily profits consistently. That's what reaches long-term goals, is the ability to make it daily, to have the best of the best. And as you grow and learn and understand more, guys, the potential for higher rewards becomes evident. If you can make $200 a day consistently, every day, do it for 30 days, is there any reason you couldn't make 300, maybe add a contract? Is there any reason you couldn't double it by doubling the contracts, taking the exact same trade? Or even more so, and this is what a lot of you guys are doing, is you're learning to make $300, $400, $500 a day, but you're mirroring it. You're using a trade copier, and you're saying, I'm going to make this $100 a day and then shut it down. But I'm going to do it across 10 accounts. And you can do that with a copier, which means that technically you're making $1,000 a day from the 2 to 3 minutes it takes you to find that 100. And guys, that's the goal. Once you can do it consistently, the sky's the limit. But you've got to go through a couple different things. You've got to learn how to have an edge. You've got to learn to follow rules. You got to learn to manage it. And that's one of the wonderful things. That's what we do in this room every day, as we talk about all these things and we give you all these things. So I'm dropping a zip file in the room right now, and that zip file says all you need. And inside that file, ladies and gentlemen, is Chart Reading 101. Inside of that file is going to be the high probability checklist so that you can get through the chart reading. You're going to have the KISS plan, defining your entry, helping you manage and taking you to that 50-50 trade. You're going to see the daily goal sheet in there, the same thing we just talked about, learning how to make it. You don't have to make it all at once. Inside, there's a document called the pictures you can take. These are the pictures that I take every trade. I take a picture pre-trade. I take a picture during the trade. Whoops. I take a picture after the trade. And I take a picture when there's no trade. And I annotate them all. Did I follow my rules? Is there a way to manage it differently? This is the whole thing. How did I do? Let me go back and study it. And then the no trade is my favorite, because the no trade keeps you focused on rules, guys. And if you put the no trade pictures in the room, sometimes what you'll find is that you could have taken the trade, and I'll give you that feedback. So take a lot of trades. Everything that we've discussed in the first hour has been broken down into 2 pages. Why we do it, how we do it, where we look for it, the different advantages, all the way down to how to study it. And then also in that file is the PowerPoint that I used to teach each and every morning. Whoops. Let's save it. So you literally have all you need to be successful with the software. You have rules, you have a place to study them, you know how to study them, you have the ability to get feedback on all of your study. The only thing that you don't have yet is the repetition for it to become easy. Um, I teach this class based on a concept that ticked me off to no end when I first started with the software. There was a word that people threw around, and that word was obvious. It's obvious this is your entry. It's obvious that's a termination. It's obvious this is momentum. And guys, I don't believe anything is obvious for new users, which is why we break down the three concepts individually, which is why you post in the room for feedback to make sure that you're reading them correctly, and which is why you go through the repetition of all these pictures and all this study so that it does become easy, because it will become obvious. And the brand new user feels like this, drinking from a fire hose, and it goes away around day 3 if you keep it simple. It really, really does. So when we get into the second hour, every chart posted goes back to momentum, path, and entry, no matter what kind of trade is being presented. I'm going to encourage new users, do not be the trade police. You will see trades that are not high probability trend trades. You will see trades that appear to break the rules that we just talked about. Understand, these aren't your trades. These are their trades. And everybody's in a different location. We're going to talk about momentum, path, and entry on every chart, no matter what you post in this room. So guys, I need you to do me the favor. Talk about momentum, path, and entry on every chart. Whether you need the feedback or not. If you're posting in the room, you're opening the door for feedback. If you're just showing off, I love it. Show off your great trades. But understand, I'm probably not going to get too extensive into them. Todd, is that a tech question? Why does this happen on a demo account? Liquidation only contract. Typically that happens if you run out of money. So when you look at your demo account and you go to the simulator, like over here, then I'm not sure why it's doing it, to be honest with you. What you might want to try is right click and edit the account and just reset it. See if it'll let you reset it and start fresh. I don't have a definitive answer for you. That would be the approach I took. I would just try to reset it and see if that opens doors for you. I'm not sure why it does it on the demo account. Maybe they're just setting you up and saying, hey, don't blow out your account. I don't know, making you think about it. And if you can't seem to alleviate the problem, feel free to go to Jason in Tech. He'll probably have an answer instantly for you. But I haven't been on a demo account in 6 years. So I may have just slept and forgotten. All right, guys, go stretch your legs. Go pet the dog. Go have a drink, whatever it is you need to do. I'll be back in about 4 or 5 minutes, and we'll start clicking on pictures. And then the last hour, guys, or maybe the last however long it needs to be, when we get through all the pictures that you guys are posting with NinjaTrader, we're going to jump into TradingView, and I'm going to try to be really thorough and create a video for it. So I'll be back. Talk amongst yourself, post them if you got them. All right, guys, I am back. So Roy, on crude, the contract rolls tomorrow. That shouldn't affect whether or not you're able to take a trade on demo. Um, and just, I'm going to share something real quick. It's the easiest way to find answers. Demo count means that the account is restricted to closing existing positions, cannot open new ones. Usually happens when the account has reached its risk limits, such as daily loss limits, maximum drawdown during simulated trading. To resolve this, you need to check your account provider's specific rules for resetting the account or unlocking it for new trades. There you go. So you guys can go through that process and see if you can come up with the answers that you need. I'm going to scroll up to the top, guys. We're going to start looking at some of the pictures that you guys have posted. And see if I can't give a little feedback. Remember, everything is momentum, path, and entry, guys. That's the goal. And we'll see what happens. Paul says, Mark, check it out. I have a giant chart with odds favorable momentum. The chart next to it has odds favorable momentum. My 13.2 has odds favorable momentum. And I took a beautiful entry on the way back to support inside of triggers. And I got paid all the way up to resistance. And dag nabbit, Paul, what a great trade. And here's the cool thing is, Paul, that's all I needed to catch this amazing trade. Large chart, small chart. Whoops. Guys, can you hear me? Give me a Y if you can hear me, please. Nobody? Uh-oh. All right, one second, guys. I'm coming back from the great beyond here. Gonna reconnect. Find my education page real quick. Education room. There it is. Pop it up. Can you guys hear me now? Are we good? Anybody? Nope. Shoot. So I need to reboot. Room. I'm so sorry, but it will bump you. And you will, whoops. And for you guys in the wonderful world of YouTube, I apologize for this. Sometimes this happens. Don't know why it happens, but it does. And I messed up. I need to reconnect. Go to the education room, shut down, disconnect and end. There we go. And then I'm going to start a new stage. Come through. Can you guys hear me now? Is that better? Do we have sound? Yep. Okay, awesome. Sorry about that, guys. I don't know why that happens. It's the weirdest thing ever. So we'll kick back a second and wait for people to get back in. And guys, did you see Paul took, and Paul knows. Paul took odds favorable, potential to break, perfect entry, easy money. And we talk about this every day, and we talk about it. And the reason I did this, ooh, Paul, we're going to address one of the things here. 1, 2, 3 divergences in the same area, Paul, that's a termination condition. So guys, one of the termination conditions that I took out of the little spreadsheet this morning was if you see 3 losses of momentum, 3 divergences in the same price range, that's a termination condition. That is a precursor to things going the other way typically. So Paul, you actually had a strong bottom because of those 3 divergences, because of the reversal. You did have the strong bottom, and the strong bottom is what makes these 50-50s pretty amazing. And just everything about it is absolute rock star. These are the ones that I miss sometimes. So obviously, I missed it the first time I talked about your chart. So very cool. So when you have a strong bottom here and a strong bottom here, what a great opportunity for you. And this trade is amazing. But the point I was going to make, and guys, you guys will find your way. You really will. You'll find your way. All it took to really be able to take this trade was 2 charts. Paul has a little more experience, and Paul's looking at 1, 2, 3, 4, 5 charts. For some of you, the extra charts create a sense of security. For some of you, the extra charts make perfect sense. For other people, it's too much information, and you'll talk yourself into and out of things because of the extra information. So you'll have to find your way. But your way, if it starts on 2 charts, that simplicity makes it a little easier to see things. And not always necessary to have more to do it. All right, Pete gave us a couple here. Let's see what's going on. Trading the girlfriend's account, so only a 2 lot, strong bottom, triggers rolled, up and separated, odds favorable, clear path. I agree 100%. This is an awesome, awesome look. Pete takes the perfect high probability trend trade entry, gets paid, and he exits the position after the 3rd divergence. Really nice. Yeah, paralysis by overanalysis. And everybody's different, guys, and I don't assume to know how your brain works. And there's a lot of you that can look at a million things and do just fine. I'm not one of you. So I think, and this is my own opinion, and it's worth exactly what you pay for my opinion, which is nothing. I believe that it is easier to learn software if you give yourself less to look at. I believe it's easier to learn how to be successful through simplicity. And once you're successful with simplicity, feel free to add, because you can always repeat the things that were bringing you success. So if you're finding a way to capture $300 to $500 a day through high probability trend trades, that's awesome. You'll find more opportunities outside of it, but don't give up what's been making it easy for you. So Pete, absolutely perfect, odds favorable, clear path, perfect entry. And even on a trend trade that fails, there's those 3 divergences that we saw in Paul's. Pete still finds a way to get paid. And then when the 3 divergences do print and all of his indicators roll, he rides small chart momentum down all the way to trouble on the large chart. And this is awesome. Now she can go shoe shopping, 15 minutes work. $790, guys, 15 minutes work. You just got to find your way to capture. And then the trade's so nice, I would say he posted them twice, but he didn't. All right, so now we get a lesson, and you guys are going to like this. So this is his first one. He broke it up, and he says, check it out. I've still got momentum. My path is clear. And there's a couple things that I notice. And guys, I'm a huge fan of honesty and annotation. If you're anything like me, you will fudge your annotations for what you wish it was as opposed to what it was. So Pete said odds favorable momentum. I say that the separation is no longer there. So while the triggers have momentum, it's not odds favorable momentum, and the first advantage is not present. It's a market that's going up, but the momentum is visually leaking. The gap, it's weakening. The gap is no longer present. And when you begin to recognize and read your indicators, you'll know that there's opportunities here. So he definitely has a clear path. But let me show you why this is important, or why I believe it's important. Rule number 3 says pull back to an area inside of triggers. Well, what we can look at on this one, no, don't do that. What we can look at on this one is that the momentum was not odds favorable. The area was not inside of triggers. And there has to be a point where you say, as a brand new user, 2/3 of my advantage is gone does not seem like a good reason to enter. And that's why we talk about these 3 basic rules at first. This is why I want you guys getting to the point to where you always say this, that, and this, and identify them. And now let me go back to what Pete just said, because Pete's at a different place than you guys. When you grow with the software a little bit, you can say, well, I know the momentum isn't the best, but my path is clear. And I don't have an area inside of triggers, and you're literally telling yourself, I'm missing 66% of the things that I look for. Your brain will say, you know what? It's only a 5-tick stop. That 5-tick stop, ladies and gentlemen, on a 4 lot is a $200 loss. And this is what we call an avoidable loss. Because here he goes short from 66, but he's not even making money on this trade. He's making up for avoidable losses for the first part of that trade. And Pete's got a great plan. And I love Pete's plan, and it's Pete's plan. It's not my plan. But you'll change what you're willing to do based on your understanding of the indicators, based on the time you spend reading them. And Pete, you also had a divergence up top. So not only are you losing money on the losing momentum on the large chart, you're also losing momentum on a small chart. So the two kind of work together. And then Pete says, all right, that one didn't work. That's cool. I'll take my hickey. That's all right. Because with this weakness, if everything rolls, I'm just going to run it the other direction anyway. And that is awesome. And that's heads up trading, guys. And a lot of times, when something fails, it creates opportunity going the other direction. And Pete's been around long enough to know that that is the case. Great job, Pete. Took a chance outside of the rules. Didn't work. Kept your head in the game. Got it all back. Very nice. Paul, this was the one where Paul went, man, I meant to hit short and I hit long. And then, Paul, the only thing I can say about this, and it's only one chart. I can't really give you feedback on it. If you accidentally hit long and it should have been short, you let that go for 1, 2, 3, 4 bars. And this is how the brain messes with you. I accidentally hit long, and that little devil sits on your shoulder and says, hey, Paul, I know it's the wrong trade, but what if it goes up? You could make some money. And it's not uncommon to make a mistake, to identify the mistake, and then be willing to hold through the mistake, even though you know it's more likely to lose, because that's smoking the hopium, guys, and we've all done it. And if you haven't yet, you will. Where you know you're in the wrong trade, but you rely so heavily on hope as opposed to your chart reads that you're willing to even say out loud, this one's probably going to lose, but I'm going to sit through it anyway. Done it. All right, Wayne. Trying to retire that pipe. That's the hardest lesson that you'll ever learn. I'm going to tell you guys right now. Learning these trades isn't difficult. Learning these patterns isn't difficult. Recognizing these advantages isn't difficult. Being willing to do absolutely nothing when the rules aren't met, that will be the biggest challenge that 99% of the people that come through my class do. Which is one of the reasons why taking so much time to use that word advantage, to get your brain hell-bent on the idea that advantages are why we do things. Wayne says, check it out, Mark. Everything reached Fibonacci resistance. All my triggers remain below. Hell, I didn't even have momentum. That's a great look. That's an area that could stop the market. I'm also at a termination over here, and I'm exhausted at this outer band. And I also am at a termination here, and price is getting to the other side of triggers. Well, let's take a quick hit and see if that termination really does create a bounce. And the one thing that Wayne didn't do is Wayne didn't hold and hope that this became a top and reverse the market forever. Wayne said, I'm still fighting everything, so I'm willing to take a shot based on my chart read, but I'm going to get paid quickly. I'm going to manage assertively. I'm going to protect my entry because this kind of look is less likely to win than it is to lose. Does that make sense? He made a choice based on chart reading, and because he knew it was more aggressive, he managed assertively. That's the luxury that your understanding of reading indicators does for you. And then everything says down, potential to break, coming from a strong top. There was your pullback to the area inside of triggers, and two divergences probably killed the trade. But he says terrible stop placement inside the trigger blocks. It's a great looking trade, Wayne. Great quick profits. And I agree. You have to make a choice on that next stop. Once you're this deep into the trade, you could either go break even, right? Either needed to be here with momentum leaving or where the market shouldn't go. And this is awesome annotation for you guys that are starting to learn management. Go back and analyze and look at what you could have done. Look at what may have happened. And what happens is you start to build a management plan like that. Great job, Wayne. Everything says up, absolutely nothing in the way. And Wayne says, well, I'm just going to jump in and make 400 bucks real quick. Momentum and path. Great job. Not odds favorable, but definitely screaming up. Is a 50-50 look for sure. And technically not a chili dog because the back of the bar didn't clear. But still a great trade, Wayne. Nicely done. All right, now we're getting into some trading view stuff. HVA line, so termination, but that termination was 2.5 hours ago. You got in away from the HVA, got out at the 1-to-1s. All right. Trading with the big chart, Wayne, absolutely. It didn't turn into a trend trade, really. I'm not sure why you did what you did, but I'm glad you got paid. You are going with the large chart, and that certainly makes it easier. 50-50, weak bottom, no divergence. Yeah, no, I know that it was market flow. But the deal is, and so one of the things, Wayne, is this high volume area line doesn't print until this bar confirms the breakout. So this pink line wasn't there. Not at all. If you got in right here, and I can't see the price that you got in at, if you got in on that pullback to the small triggers, what you're doing is, okay, well then there's nothing I can tell you because this chart doesn't make any sense, and the stuff that does make sense is on a different picture. That's okay. But when I go back to try to give feedback, I can't. It's an incomplete picture. All right. Weak bottom, not a termination that reversed the market. Odds favorable momentum. I do agree with that one 100%. You say you entered on the correct side of the smalls, which is cool. No divergence, big range, reversal bar, and you get to break even quick because it is a medium probability trade. Did you notice the gap theory set up on you too? I love the management on this. You take a shot at it. You had that momentum. It's not a perfect look. And you say to yourself, man, with the large triggers, Dragon gets up to that mid band, likely to close the gap. And you didn't hold and hope, man. Great management. Just, I mean, perfect. Perfect management on a trade that didn't go through. The faster you read charts, the more effectively you manage trades, without a doubt. Let's see what you did. Momentum up, so the smalls are strong up. So large chart, Wayne says, you know what? I'll use the fast indicator momentum. I'll couple it. Well, there's not quite momentum on the large chart, but it is the correct side of the triggers. So you're beginning to fabricate momentum a little bit. If the smalls are inside of the large, it's just not momentum. But you had room to see if it would push to the 1-to-1s, and it did. And being left to the triggers definitely creates an advantage. Moving stop before I could move target 2. And it got you down way down here. Good stuff, Wayne. You're getting busy again. Like it. 50-50. Not quite odds favorable. Working on it. I like your strong bottom. Divergence prints on a 50-50. You get in above it with things going up. Divergence prints. And you get out. I just want to see if I can offer my 2 cents on this one. So we're hoping this area breaks, right? That's the area that we're hoping breaks. So we're looking for momentum to do it. 1 divergence is a little problematic. You take it. 2 divergences. Wayne, just something to think about as you keep making your management plan better and better, and you certainly are. If I'm relying on momentum to break this area, it's okay to exit with a loss of momentum. And that's one of the concepts. On these 50-50 trades, 1 divergence is pretty bad. 2 divergences tends to be detrimental. And the idea is that this is the look that typically breaks areas. And while you're hoping that momentum accelerates, that's not your best momentum look. So you're seeing that weakening of triggers over here, putting a stop at loss of momentum on the small chart. Right on. And the cool thing is you know divergence is true right about here. It's an opportunity for 3 or 4 ticks less loss. I think you took a good shot at it. One of the things though is that on these 50-50 trades, and this is just, I know you like data points. If I'm hoping this area is going to break, but it's not broken, taking the best entry is typically going to give me room back to the fib. So by getting in all the way up here, you're saying it has to go. It has to go. And maybe it slows down management a little bit because the bar that you hoped, this is for you guys taking trend trade entries. If the reversal bar dissects the area, that's not the area that's producing a bounce. Does that make sense? Because you're already below it. And once you get below it, you don't have any areas inside of triggers. And it does go up. And if this thing's going to go, it's going to run. So that little fluctuation. It's a cool looking trade, and I know why you did everything. And I think just a little management opportunity. Odds 50, weak bottom, 50-50, gap theories in play. So you let it close the gap to the triggers. No divergence. Catch it on the way up. When divergence prints, it's game over. So weak bottom is rule number 1 for a 50-50 to have the best shot. Everything else was absolutely perfect. And you get it on the way up, and it just doesn't go. Those sons of guns. That's a great look with the potential to break. It just didn't. Nice job, Wayne. Great trading this morning or last night. I like it because you guys all see different stuff and you do it differently. Is this a strong top? I'm asking that because of the gap, because of that space in between. That's a good question. Roy, so when we talk about strong tops or bottoms, we talk about it being a termination. Um, and I'm gonna kind of answer this question twofold. Um, when I understand how these areas come to be, and Roy, are you in here with me? So guys, your software, when you open it up, it runs thousands of calculations. Thousands of calculations. And from all of these calculations, Roy, you get that Fibonacci resistance. So if I'm a couple ticks off of it, I'll look to my small chart to give me an indication. So let's see if we can find an example. Where it almost hit. All right, so we'll look at 69.55 down here, where they get like 2 ticks off the bottom, and that was 10.01. So technically, price didn't reach the area, and that's one of the recipes for a strong bottom, because it has to be a termination condition first. But look at what happened so close to that fib. Your small chart gives 3 divergences in the same price range, and it decidedly goes up from there. So, Roy, this is one of those ones where I say, okay, it didn't reach the area. Technically, I can't call it a strong top or bottom, but my small chart is showing me that there definitely was a big decisive change a couple ticks above it. And that's where you just have to make a judgment call. If there's no divergences, nothing at all, and it doesn't reach, I'm like, yeah, no, that's not a strong bottom. I'll get my guard up here. But if it misses it by 2 ticks and my small chart says, hey, I want you to see all the shenanigans going on a couple ticks from that area, all the losses of momentum, the reversal, Roy, you might use that as a judgment call. So strong tops and bottoms for the new user look like this. And see how it ran above? Same thing, it could be a couple ticks below. Your small chart very often will give you an indication of whether it just got stopped a little short or not. Does that make sense? So the very basic is it reaches it. And then as you grow with the software, you'll be able to use your chart reading to perhaps make a judgment call. And when would you need to make that judgment call? Maybe you're looking for a 50-50 trade the other direction, right? And that's rule number 1. Maybe you're looking for a high volume area trade. And that's rule number 1. That's a great question. Thank you for that one. And guys, that's one of the things you can do in this classroom is it doesn't have to be a trade. It can be anything that you see. Drop it in the room. Talk about it. Ask questions about it. I love answering questions. All right, Paul, 3 times. I love it when you guys post multiple charts. All right, so your biggest chart was trading directly into a termination condition. Your 13.2 was trading directly into a termination condition. Your small chart directly into a termination condition, and it didn't work. And Paul knows it, traded into termination. And I know this is going to sound weird or funny. I like it when you guys do this. And Paul, I'm sorry that you had to lose a trade, but guys, losing trades is a part of it, right? Imagine, if you will, so you're in at 87, 11 ticks, 4 contracts. So that's a $440 loss. And that's okay. That's part of the education process. I can't stress this enough. But it's avoidable. And that's what you begin to realize, and that's really what you begin to believe, is you start saying to yourself, I don't have to take this trade, hoping that it still goes up, right? Paul, You could have just taken this trade and made all the money up to the termination condition. But since you didn't, maybe you weren't in front of it, maybe the dog was barking, um, you didn't take it, and you're like, oh no, I better take this one where the rules aren't met. And Paul probably didn't really say this, guys. This is how I played it out in my head. Because I didn't catch this trade, because I didn't make this money, my brain tells me, Mark, I know it's not right, but take it anyway. Because you've already missed out, and your brain will force you into believing there may not ever be another trade. Mark, that was the last opportunity for you to ever make money in crude oil. It's just never going to happen again. And for whatever reason, we believe it. And I think that's when we tend to take chances, is if we miss the easy ones. But through the repetition and through taking these losers and saying, wow, this is the greatest thing ever. Paul says, I traded into a termination. So not only did he acknowledge that he gave up the advantage, but he also had to sit through the result. And Paul, I firmly believe when you do this enough, you stop trading into termination conditions. If my own past is any indication, you'll stop. You'll get sick of losing trading into termination conditions to the point where you just don't do it. If that damn fib wasn't there, Paul, it was the perfect looking trade. But rule number 2 got you. Momentum, potential to break. Momentum, absolutely nothing in the way. Rock star entry, and that's it. Holy smokes. And this is a part of it too. This look whipped my butt. This look was effortless and over so quick. This is such a good trade, Paul. Guys, look at that entry. For those of you that are still learning entries, I want you to see this. Paul bought the low tick of the bar. 2 ticks above support. Paul, when this went up, you had $30 of risk on the trade. Maybe $30 of risk on the trade. This is outstanding. That's the one. And watch this. 2 divergence. Why did Paul ignore 2 divergence? Because if it's not 3 divergences, it's not a termination. Outstanding trade. All right. Momentum, room to the target. Momentum, room to the target. Perfect entry. Outstanding, getting paid before trouble. And Paul's a good sport, so I'm going to turn this into a lesson for everybody. The education process is realizing what you can do wrong and what you can do right, and doing it repeatedly until you only focus on the right. And Paul, can't we agree that if all you took was this trade and that trade, it'd be a pretty good day? I mean, $500, that's a pretty good day. And that's what we're working towards, guys. Making the mistakes so we can learn how to correct them, and then learning how to correct them so that we can eliminate avoidable losses. Thanks so much, Mark. Your question helped you a lot. I guess I was struggling with your entry, but Q&A helps you a lot. I appreciate it. Roy, thank you for that. That was perfect timing, and I didn't even see this comment before we did it. I'm such a firm believer in the feedback. I really am. And not because I'm the one giving it. Not because I'm the one giving it. Great job, Roy. Just because it's just chart reads. I have zero stress when I look at your charts. I can't say that enough. When I look at Bob's chart here, I see exactly what Bob sees. The triggers are weakening, but they're still outside. Bob sees a clear path. I see a clear path. Bob is calling this a strong bottom because the large didn't get through. The small barely went through. And check it out, Roy. He had a divergence down there kind of supporting the idea that it's not, that maybe it's a little overrun. Maybe they didn't make it. And there were 3 divergences down there. And Bob says, I'm calling this a strong bottom. You can't stop me. Says he misses the first one. That just wasn't your money, Bob. That first one was them going, all right, Bob's getting coffee, but we're going to go hit it anyway, just so when Bob comes back, he sees it. And then they come back for you. And you get in a little early, and you get out super early. Came back, entry 2 ticks above the mid band at 17. Oh, it just looks weird. Nope, that's perfect. And then you're out at 27 and 37. It's only showing in one spot. So Bob, that was $300 over the course of 9 seconds. Is that right? Took you 9 seconds to make $300, Bob? So the time and the money is irrelevant. Let's look at the pattern. Momentum, path, pull back to support inside of triggers, easy money. Hold on. Momentum, path, pull back to support inside of triggers, easy money. Momentum, path, pull back to support inside of triggers, easy money. So Bob and Paul, you guys aren't in the same room, right? You guys aren't on Skype saying, hey, here it comes, take the entry. No, you're trading the pattern. You guys are amazing students. Nicely done. All right, Pete. Momentum, path. The areas are on the wrong side of the triggers. He recognizes it. Rule number 3 not in play. And he says, I don't know if, when, or where this is going to bounce, so I'll catch it on the way up. And he does perfect. Nicely done, Pete. And this goes back to the idea that when you know the rules, you know when they're not met. And when they're not met, it doesn't necessarily mean there isn't a trade for you. It means that you may have to alter a little bit based on your chart reading. And Pete's really good at that. A lot of you become really good at that. And it's all a byproduct of saying, I have momentum, I have path, where my entry. Oh, I got you, Jen. No worries. There you go. Is that better? Trina, I missed you. I'm sorry. Did I miss you, Trina? Did you delete it? Oh, you two on the video. Okay. Whew, I thought just having video troubles. Yeah, guys, if that ever happens, tell me right off. If you ever can't hear me, tell me immediately, because I don't want you to sit there and go, well, maybe it'll come back. I'll reboot everything on my end, guys. I'll do whatever I can to make sure you don't miss out on any lessons. So, good stuff. So let's go do a live chart read real quick, and then we'll take a minute, and then we'll come back. And guys, I'm going to create a brand new YouTube video. So I'm actually going to stop this one. We made it through the first 2 hours of class. We've gotten feedback on every chart. And I believe the one thing that is a constant is you guys with momentum and path, we're taking really easy trades for outstanding profits. So if you are struggling with believing that, if you're trying to find all the trades instead of the best trades, I want you to understand there's a lot of opportunity and simplicity, and then you'll see it more once you get through it. So the S&P right now has a weak top. It's a termination. It's not a termination that reverses the market. It kind of came from the middle of nowhere. But there is odds favorable momentum. But I don't have a clear path into these yellow 1-to-1s, and I don't have a clear path through this fib. So what I kind of have to say is even with this momentum, I'm probably better off sitting on my hands and doing nothing. I'm probably better off because I don't have a clear path, not hoping this mid-band continues the market all the way down. Some of you will take it anyway. Some of you might even try to go long. That's up to you. But the very core says the trend is down, the momentum is strong, but the path is not clear. And you can see that the small chart is already reacting from the 1-to-1. Oops, that is my NASDAQ testy chart. This area had the potential to break even from a strong top. Divergence is the #1 killer of the 50-50 trade. And guys, it killed it dead. If you're a crude oil trader and you took this short trade, post it in the room because the conversation we have may keep you out of those losers. You might not have needed to lose that money, but I don't know. I don't know if you need help if you don't post. Are there any questions before we get off of the NinjaTrader and I go over and I start flapping my gums about TradingView? Because I'm going to do TradingView. I'm going to talk about the indicators. We're going to play around with TradingView, entry, exit. I'm going to show you guys how to set up replay. And we'll talk a little bit about the trading plan as well. Are there any more questions regarding the software on NinjaTrader that I can help you with? No? All right.